My name is Jens Klatt, and I'll introduce you to probably 3 of the most profitable candlestick patterns ever seen, ever seen. Well, in the FX world, in fact, and it's statistically proven. So it's an interesting topic, in fact, because many of you probably have wondered over time. Are these candlestick patterns, which you can read so much about in books and forums on social media, and where some people are referring, traders, analysts are referring to hammers or evening stars or bullish engulfing, bearish engulfing patterns and all this. Are these patterns really that profitable? And if they are profitable, how profitable are they? And in fact, you will learn more about profitability, respectively expectancy, in regards to candlestick patterns in today's webinar. And I have to say, I'm somehow really excited to guide you here through the upcoming something like 40 to 45 minutes. And you will see, I thought about this, and I just realized that when we go through all this right now, it's to some extent very interesting, very fascinating, yes, but to me, it was like there was a missing piece. And so I thought, well, probably I will find one of these patterns in the chart right when I look at it right now, and then I found out that we currently face a very, very interesting pattern in the real FX world in dollar JPY, with dollar JPY currently eyeing a very, very important region of support. And I will give you just an idea on how to use the knowledge here, the theoretical knowledge, which we go through in the first part of this webinar, how to use it in the practical world, in the world of trading. Then, and we'll look at a real life example right now, real time in the markets. And before we start, first of all, it's very important to look at today's agenda. So first of all, it will be a quick introduction to candlestick patterns in general. In fact, I can tell you already that my career in the financial world, when I started to read books on trading, the first book was John Murphy's Technical Analysis on Financial Markets, and the second book was Steve Nison's Candlesticks. And so it is a part of my trading career right from the start, in fact. And I will give you 2 books in this case. So the second part, the 3 very profitable candlestick patterns, 3-line strike, 3 black crows, and evening star. The thoughts behind this were published in another book on candlesticks, which I also give to you then. And you can use information. Probably if you're interested in reading more about this topic, I highly recommend reading these books. And then the last part will be the practical part, when we will switch over to the current picture we face in dollar JPY and how to use this knowledge here. Then we could now start to talk about me. I don't think that's so interesting, at least not for me. So my name is Jens. I'm located in Berlin, in Germany. I'm in the financial industry, in the trading industry, especially for 15 years, more than 15 years now, around 15 years, yeah. So I'm about to enter the period when I can talk about 20 years in the markets. I learned to trade the markets from scratch at the big stockbroker here in Berlin, in Germany, after I went to work for a bank. After I finished school, I was unemployed with a bank for 2 years. After I finished my traineeship there, I went straight away to the stockbroker, to the trading desk. I did this beside my studies as a trading assistant, and took it from there then, in fact. And after my studies, I studied mathematics and economics. I went out and built a research and education arm for a big broker. And after 5-6 years, I decided, after building a name, a reputation, I started to decide to go out myself. And here I am today. So, but what's probably more of interest is the broker behind this webinar series. It's Admiral Markets. Admiral Markets is one of the biggest brokers, in fact, in this industry, especially as a financial service provider in the FX and CFD industry in the markets there for also nearly 20 years, in fact, so 19 years. It's this slide is from last year, 18 years of reliability, and now it's 19th year. And what's especially noteworthy, and this is very important, I learned this over the years, is that Admiral Markets is a global financial service provider. Global is really global. It means that Admiral has 20 offices around the globe. And if you have any questions around your trading related questions, around your account related questions, around whatever, it's not just that you can visit the YouTube channel and check out all the videos there, or the website with all the written material you can read through, but you can also contact someone at a desk around the globe, speaking very likely your native language. Talk to him and ask him all your questions. And I think this is very, very important, beside the fact that Admiral is also one of the most competitive brokers out there when it comes to spreads, respectively commissions, or costs you face when trading the markets. Is very, very important for professional traders. In fact, the cost component. And Admiral is, at least here in Germany, known as the so-called DAX 30 expert, in fact. So there is no broker in the CFD universe out there who has a more competitive offering, in fact. In addition to that, today the topic is mainly Forex. So FX, this is also true that you can check external websites, so third-party providers in regards to, for example, spread indicators or spread charts. You can compare brokers with each other in regards to the cost of trading, which is the spread you pay, so the difference between the bid and offer. And you can see there that Admiral Markets is also one of the, if not the tightest broker out there. So definitely give Admiral a look. Visit the website admiralmarkets.com for further information. And yeah, so let's be thankful that Admiral makes all this possible here. So now let's have a look at candlesticks. Let's have a look at candlesticks and what candlesticks are and how these candlesticks are built. In fact, to some of you, this might probably be not of that high interest because it's quite basic, but I have to say, over the years, I learned that the more I looked into such basic stuff over and over again, it was fascinating to see that I learned something new nearly all the time, and that's probably worth then to give it candlesticks and how these candlesticks are built a deeper look. And so first of all, candlesticks are originated in Japan. So they are a technical trading tool, and they were introduced to the Western world through a guy called Steve Nyssen. And this guy, Steve Nyssen, I mentioned him already at the beginning. He wrote a book. I have it here. This is the English version. So I read the German one. But this is the English version that you hear. It's called The Candlestick Course from Steve Nyssen. And you can see that the first time the book was published, I'm not sure, can you see it here? No. So it's at least 2003. I think it was already available during the 1990s, if I'm not mistaken. So, and Nyssen really works through all the details in regards to candlesticks, in fact, and introduced this concept here around 20 years ago. So before that, we were all used to bar charts or to line charts, but candlesticks provided more information, in fact, and show data for multiple timeframes, in fact, into a single price bar, and build patterns then that try to predict price direction once completed. And Nyssen was the one who introduced this to the Western world, and yeah, he not just introduced it, but as you have probably seen, this is now the default you will find in your trading station. If you open the Admiral Markets MetaTrader 4 or 5, yes, you have the chance to look at bar charts, and yes, you have the chance to look at line charts and all this, but the default is usually candlesticks charts. And whatever webinar you will look at, it's usually the case that you look at, in this case, candlesticks. And the reason for that is because of all the information which is included within them. And so there we go. this is what I just said. Candlestick charts show data for multiple time frames into single price bars and build patterns that predict price direction once completed. And now there are various candlestick patterns used to determine price direction and momentum. So it's not just one pattern, but it's probably it's many, in fact. So that said, there are many patterns. Before we now dig into the body and how it's built in case of candlesticks, these many patterns, they have certain, how can I say that? They have a level, a level of expectancy attached to it. Let's put it that way. So, or to put it differently and quite bluntly, let's just say there are patterns which are highly profitable and work quite well, depending on the market conditions, and there are patterns which are not that well working, let's say, or at least for very experienced traders and for those who really understand what's going on in the marketplace right now and can really read a chart and then use the information provided by candlesticks then to use it to predict further moves, or predict a move which is more likely to happen in one or the other direction. And so let's have a look here now at the body. What you can see here is a white body, respectively the black body. Usually what you're used to is that the white body is usually a bullish candle, while the black one is usually a bearish candle. When you look at the chart, I think what's common is that the real body, the real bullish body, is green or blue, while the real body in case of a bearish candle is most of the time a red one. So and then what you see here is the upper shadow, respectively the lower shadow. We also refer to this as the so-called wicks. And now, and this is interesting, in case of the body, the real body being white / blue / green or bullish, that means that the open price is below the closing price. So what you can in fact spot when looking at the candle is whether the market here or the candle, whatever time frame you look at, it doesn't matter whether it's a 5-minute candle or it's an hourly candle or daily or monthly or weekly, whatever. What you can spot right at the moment when you look at the color of the candle, whether the market closed higher or lower for the respective candle. And what's also interesting is that thanks to these wicks here, or the shadows in this case, that thanks to them, you can see how much the market moved in one or the other direction. And it gives an idea of how bulls and bears fight it for how can we say that? The overall advantage, or who is in charge of the action. That's the question, in fact. So for example, when you look at a candlestick pattern and you see a very, very long lower shadow, for example, but the market closing significantly above that low of the day, then in this case, or low of the candle, that means that there was selling pressure, but bulls fought back, let's put it that way. While if there is a long shadow here on the upside, you see bullish action to happen, and then the market turns around and probably closes lower. So closing lower means that it closes then below the opening price. So there's then a red candle, which means that the initial bullish power, which could be seen, is then sold off again. And most of the time you could interpret this as at least an indication that there is some serious selling pressure in the market. So that's a very rough way to explain this, but you can already see that all this is in fact possible to achieve thanks to look at a candle. And what we now want to do is, in fact, we want to look at common candlestick patterns to get a better idea of that, because now I just talked about this and I think it's easier to understand once we visualize what I just said, in fact. So, for example, this is what I already referred to at the beginning, and then, in fact, to some extent, at least between the lines a few seconds ago, when I said there was selling pressure, and then the market closes green for the day. So let's refer to white as green, so bullish, a bullish pattern, respectively the other way around. So what you can see here is, for example, selling pressure to occur. Here's where the market opens. Okay, so this is the lower line, or the lower part of the body of the candle, and then there's selling pressure. So initially this candle was red because the market pushed from here significantly lower, was sold off in fact, and then bulls fought back and the market closed in fact green. So that was, or is, if once you look at it from a candlestick perspective, a sign that there was selling pressure which was not sustainable, and now the demand is obviously greater than the supply, which is at first glance at least a sign that there's a higher chance that the market continues to push higher with the next candle than it is that it again attacks the lows in fact. Something similar is happening once you look at a so-called hanging man. In fact, even though it's, at least in my opinion, or I really like hammers, let's put it that way, but hanging man is something I don't really like to see. You will see what I prefer. If I like a hammer, you will see in a few minutes, then in fact, that I favor so-called shooting stars. So hanging man is difficult because you open here and you push lower in this case. So there's selling pressure obviously happening, and then bulls are capable of gaining some traction, at least into the close of the candle. And that's why the market is then here closing with a lower with a lower shadow here, but you can see in fact that bulls were capable of gaining some of the initial bearish momentum, gaining some traction into the close of the candle, and thus pushing back prices at least into the range of the opening of the market, which is here at the top of the candle then. So, and this is something which is not really, let's say, it's not very bearish, right? So you could easily also argue, even if you're coming here from within an uptrend, you see first bearish action taking place, the market being pushed lower, but still it's not that that it's ultra bearish. I mean, to some extent, and this is what a trader would argue, in fact, then, or a theoretical chart pattern enthusiast, let's call him, he would say, well, yes, but you see an uptrend and then there is the opening of the candle and the market pushed lower. So that's probably a first sign that there is a higher supply than demand into the market, even though bulls were capable of regaining control to some extent into the close of the candle. I understand this, but still, it's not a very favorable pattern in my personal opinion. And I think it's no coincidence that this won't be, in fact, one of these profitable patterns, which I will introduce to you in a few minutes then. So this was also mentioned here, bullish engulfing, bearish engulfing. I really like the pattern. So to be honest, I really appreciate seeing this because it's a clear sign. So you see the market, for example, coming here in an uptrend, forming a next bearish candle, and then the market opens lower and closes higher. And not only that, but the bullish candle here, the whole body covers the bearish body before. The same is also true vice versa here when looking at the bearish engulfing in this case. But let's focus here on the bullish engulfing first, because this is a clear sign that the selling pressure of the day before, which you could see here, so the market opening here, then pushing lower, some signs of the market stabilizing, but sharply sold off after, making new lows, and we are closing in around the lows, in fact, for the day, and open even lower than that. So that's potentially a sign or a pattern which you usually will see in markets which have a clear closing time, let's say. So like stocks in FX, it's not that common that you will see the market opening lower here, despite the, or well, let's take out the opportunity here, or the possibility that we are looking at a weekend, for example, and then we open lower. There was initially some selling pressure again right from the open, and then bulls fight back, and they fight back not just to gain some momentum, but what they do is they cover all the losses of the day before, and they close in range around, probably even above the high of the day before here, or the candle before, but let's put it as a daily candle in this case. And this is, in my opinion, a very strong sign, because it shows that bulls gaining traction, and it increases chances massively that the next candle will most likely be an up candle too, and the bullish momentum continues, instead of here the market then turning sharply around. And that's it's clear, it's very straightforward, it's not difficult, and you don't need to argue why. Well, for example, here there's first signs of bearish blah blah. No, it's clean, it's a clear statement. It's we open lower, we cover all the losses of the day before, and even more than that, and here close in the range around the daily highs of the day before, respectively even above that. And it's a clear bullish sign. The same is true also here when looking at the bearish equivalent in this case. Then we have the morning star, respectively the evening star. We already mentioned this, in fact, here at the beginning. This is one of the three patterns which I will introduce to you. The evening star, as you can see here in this case, it's a bearish pattern. So we go through the evening star because it will be part of the latter presentation here. So you have an uptrend, the market is pushing aggressively higher, and then the momentum starts to diminish. It's not necessarily sad that it's just one candle, in fact. So this was a mistake I made at the beginning of my trading career. I was thinking that you have the theoretical pattern, and the pattern has to be 100% the same as you saw it in the book. That's not the case. So also what I highly recommend every newbie out there using candlesticks in their trading. It's a fascinating tool, but don't make the mistake to use the theoretical picture here and try to find it in the real world, because you won't succeed with that. In fact, use common sense. Does it make sense? Does the picture which is painted there, thanks to candles, you can start to write a story around this pattern in this case. So I think when we're looking at charts, for example, when my wife comes into my office and I'm sitting here having a trade open or something, she's just looking at me and just shaking her head in disbelief and just like, and this is something you can make money with? What is this? I mean, this is some, yeah, what is this? This is some green and some red. What is this? Darling, it's candles. Yeah, okay, let's call them candles. And then, what is this? And you can make money with this. So what she wants to say there is it's very abstract. And candles help you to make a story around this. And it's a coherent story. It's not a story you make out of some mumbo jumbo, but it's a story which makes sense based on the price action you can see here, thanks to just some candlesticks, or some, yeah, in this case, candles you look at. And this is something I highly recommend, especially in newbies. Don't look at the pattern, try to find it in the real world, because it doesn't appear there in its clear form. But here, in case of an evening star, for example, you will also see this when we try to use this three-line strike pattern. We will look at, in fact, in the real world, in dollar JPY. This is the pattern I just recognized there. You will see it's not that we're selling off from there, but the market starts to stabilize in a very volatile environment, and this is exactly what's happening here. It's in this case, in case of it's not a how can I say it? What's the word for this? It's not the reversal, but it's not reversal, but it's the break of the trend, let's say, or it's a counter signal, which means you have an uptrend and now the market is turning. Let's put it that way. And here in this case, you have an uptrend and the market starts to stabilize, consolidate, and then sells off, which shows that the further demand, which was higher than the supply, is not just diminishing, which is here the first sign of the evening star, but then bears take over control and the market turns and then pushes lower. But there's also a possibility to use this evening star. It's like taking a breath. You can also use an evening star then in this context as kind of a consolidation. I use it in another way here, and then we're not talking about a pattern which is like indicating that now the buying pressure diminishes and the market is turning. But in my case, when you look at evening stars and volatile candlesticks here in this case, it's like the market is probably very extended after a strong run higher. But if it's not seeing a deeper corrective move, it shows that the demand is still higher than the supply, which is a bullish sign, in fact. And once we overcome this, then the breakout will happen on the upside, even though in case of an evening star, we usually refer to a so-called bearish candlestick pattern. And then there's also something, again, I don't like the inverted hammer. It's similar to the hanging man, but I really like the shooting star. The inverted hammer here as the hanging man is something which I need to explain, and it's not easy to explain, in fact, but I need some story I make around this. So we come here so we are in a downtrend. The market opens, pushes higher, but then bears fight back, and the candle we see is a bullish one or a green one, so that the closing price is higher than the opening price. Still, here bulls who saw a strong demand over the day and some strength which they showed here, where or bears fought back, in fact, and pushed the market lower again from these highs. And this is something which is not really bullish. But in case of a shooting star, there's something. This is the difference, or it's similar. It's the other side of the medal when looking at the hammer, in fact. So you have an uptrend. The market starts again very strongly, pushing higher, but closes lower than on the day, and producing such a shooting star pattern. In fact, this is also something we could have seen for about, I think, 3 weeks ago, or so 2 weeks ago, in the Nasdaq 100. Even though this is a perfect example. What happened in the Nasdaq in this case, it's a perfect example of that. It's not the candlestick pattern alone which needs to make sense, but in the current environment, for example, there's also the bias, the sentiment around market participant, which plays a very important role. So the whole picture should make sense when using candlestick patterns. Just looking at a chart, take the candlestick pattern, say it's a bullish one, and so I'm long, or it's a bearish one, so I'm short. This is not getting the job done in case of trading. It probably gets the job done once, but it's not that you will make money out of this over the long run. And in case of a shooting star, again, it's to some extent self-explaining. So we are in an uptrend, the market opens, pushes higher, and then reverses back to the opening price and closes below that with a bearish candle, producing such a shooting star, showing that the bears took over, that supply overcomes demand more and more, overcame demand, in fact, for this day, if it's a daily candle, and increases chances of the market then turning lower from here. So that's it around common candlestick patterns, how you could interpret them. Now let's have a look at these 3 patterns, which I already introduced to you here. It's the so-called 3-line strike. It's probably very interesting for you because 3-line strike, it's not the most common candlestick pattern you have probably heard about. So I think bullish engulfing, bearish engulfing hammer, all this is common, and we have heard about this for quite a while. It's also very detailed described in the book from Nyssen, but 3-line strike is probably not very common to any of you. And this is now the thing. Here in this case, 3-line strike is a candlestick reversal pattern aiming to predict a change in, and by the way, I just made a mistake. I just realized I made a mistake. I referred to the pattern we will look at in the real world as 3-line strike. No, it's 3 black crows, in fact. It's not 3-line strike, I'm sorry. Because 3 black crows is in fact a continuation pattern, while this 3-line strike is a reversal pattern, which aims to predict a change in price direction. So from a bear trend then into a bull trend, let's say. So in case of a bullish 3-line strike, we see 3 bearish candles with each bar posting a lower low and close near the intra-bar low. And the 4th bar opens lower and makes then the 4th low of the 4th bar, but reverses in a wide range outside bar and closes above the high of the first candle in the series. So let's just look at this and remember what I refer to in case of bullish engulfing pattern. That's very, very similar, in fact. But in this case, we are not just looking at the coverage of one candle before through a bullish candle, but we are looking at the coverage of 3 bearish candles before, which is increasing the chances of a strong reversal even more than that. And so the book, you already saw at the beginning, it's the encyclopedia here of candlestick charts, which was written by Thomas Bulkowski. The book here, he analyzed these patterns, shows that this pattern has an accuracy rate of 84%. And just to give you a better idea here of how it looks, so you can already see this is very, very similar to a bearish engulfing, in fact. So I'm sorry, bullish engulfing in this case. So you have here 3 bearish candles as described here. All of them have a lower low each time and a lower high. And at the end of the day, or at the end of the day slash here, the 4th candle opens lower again and then reverses strongly back. I'm sorry. One second. Probably I take a. Okay, better. Okay, reverses strongly back then and produces here this wide range outside bar, which shows that demand is aggressively and significantly overtaking supply here in this case. And this is the pattern 3-line strike. Now you can screenshot this and then look at your chart if you find such a pattern, in fact, and take it from there. Respectively, what I also recommend you to do is have a look here. Have a look here at this book from Bulkowski. Let me just share this link here in the chat box probably. And all of you now watching the recording of the webinar on YouTube, if you like what you're seeing, 1 second. How do I do that? Candlestick. Let's just call it Candlestick book. If you like what you're seeing on YouTube, please leave a thumb up here. Also, if you have any suggestions in regards to further webinars, topics you'd like to hear something about, feel free to share them in the chat box, and also feel free to check the description box. They will find the link here to this book from Bulkowski, within which you find also all the, not just the patterns, but also the accuracy rates he worked out here in a very, very detailed manner. And now let's go back to the presentation here. Let's have a look now at the 3 black crows. So 3 black crows is a candlestick pattern. So it's also a reversal pattern aiming to predict a change in price direction. And it starts at or near the high of an uptrend, in fact, with 3 bars posting lower lows that close near their intra-bar lows. And then the pattern predicts that the decline will continue to lower lows, resulting in a broader scale downtrend. And Bulkowski has here an accuracy rate of 78%, in fact. It's also shown in this encyclopedia of candlestick charts. And you can see here, so we are coming here in an uptrend, and then we're posting 3 black crows or 3 red candles here, which are all opening lower and closing lower than the candle before. And now the thing is, the question now is, does it mean that we go straight right after lower from there, or is there probably a consolidation or a short pullback or something? And this is, I think, where it makes sense to look at the current chart. I haven't opened, by the way. I hope this is not a problem, but you can also surely see all this in the MetaTrader. But I've opened it in TradingView, in fact. So don't be surprised that the chart looks a little different right now. But this is $JPY, and right now we're here seeing this aggressive push lower. And by the way, gold just made it above 1,905. It's only 15 USD to go in regards to a new all-time high. So this is a very significant development we currently see. Yields are still stable. That's a surprising sign, but it's also a clear sign that markets are very aggressive in regards to selling off their US dollar holdings. What I just did is, in fact, I presented you something on top of the technical thing. So we can just purely look at it from a quantitative perspective, and we just could look at it and say, okay, this is the pattern. Now I go for what I just identified here within my chart. But in at least my global macro trading, I call it, it needs to fit the whole picture. And what we currently see is US dollar being massively under pressure, yields pushing lower, we see gold pushing higher. In such an environment, in such a world, dollar JPY stays under pressure from a pure fundamental perspective. Okay, check. And now what I do is I look here at, for example, so I think this is a 3 black crow pattern. I think we have already 2, in fact. So we can see it here. So the market sees a trend higher, okay? So there's an uptrend. And then you can spot right here 3 candles which fit perfectly our description of the 3 black crows. You can see here, we are, and this is the reason for that here, as you can see, has to do with the fact that we are a 24-hour market, so that you won't really see a significant gap, something in between here. But you can see that we close 3 candles in a row lower, and then you can see there's a short consolidation, we can call this, and then we sell off sharply lower from here, which is mainly driven by the fundamental developments back then. And so this could be a coincidence, let's say, okay? So for whatever reason, we saw such a sharp drop here. We could easily explain this with all the developments around Corona, okay, fair enough. But this is something which you probably don't see coming. But what we currently get to see is different, because now have a look here. It's not a perfect uptrend, but there's at least some signs of bullishness here after the market is not breaking significantly below 106 again. And then it trends higher here. And you can see now you have these 3 black crows, in my opinion. It's a fact, you could also argue it's 4, but it's just those 3 we look at here. Then we have the consolidation, and this is what I refer to, the consolidation part of this. So it's not necessary that we just break aggressively lower after spotting these 3 black crows in this case. We did it here, but it's not necessary in my opinion. But we can consolidate even for a quite extended period of time. So we look here at the last candle, the 3rd black crow in this case, or the 3rd black candle, the 3rd red candle in this case at the 10th of June. So it's more than 1 month ago. And then we have the consolidation. We also see that the market drifts lower, finds a consolidation here or a support, and is now breaking the support. And again, the sentiment is aggressively switching against the US dollar. Lower lows in yields should be expected. Dollar JPY is usually negatively correlated to yield developments, the other way around, positively correlated, which means if USD yields are pushing higher, US yields, 10-year yields are pushing higher, dollar JPY should usually follow. If they drop, you expect dollar JPY to drop too. This has mainly to do with the fact that JPY is a 0 yield currency and is a funding currency for carry trades. And this is currently exactly what's playing out here. So we're anticipating a drop in US yields to 0, in fact, probably even into negative territory, which is extremely bearish for dollar JPY. So this is the fundamental side. We have quite solid positioning when it comes to market participants being positioned in regards to the US dollar. So it's not a sentiment extreme we find ourselves in right now. And in addition to that, we have this technical pattern. So the 3 black crows, and now we are going lower from here, which means chances are extremely high that from here there will be a significant break lower because the overall picture fits. And in addition to that, by the way, we can also argue here, well, we're breaking just the May and the June lows. So in this case, this is an additional catalyst, bearish catalyst probably. And this is how you could use these patterns, the knowledge around candlesticks in general, and the story they tell you, how to put it into the whole picture and then formulate a trading idea based on that. Certainly, this what I just did is more, it's a different trading approach. It's not ultra short-term scalping, day trading, whatever, but it's more like a fundamental sentiment technical picture which fits more a global macro picture. It's not happening that often, but if it happens, it can produce very attractive risk-reward trading opportunities, in this case in the FX world. And especially then the strength of FX and currency pairs to be very stable when it comes to established trends could play out really nicely. Especially, it's not that it's stress-free, but it's more, you can focus on the important things, on accurate trading, in fact, and manage the trade accurately. In case of very short-term trading, you're sometimes very emotional in and out, and not really focused on the trading, on the process itself, which is sometimes one of the reasons why beginners have so much trouble gain positive momentum in their trading, in fact, at least based on my personal experience. So yeah, that's around it, the 3 black crows and the real world. And now finally, let's have a look here at the evening star. Let's have a look at this pattern. So the bearish evening star is also a reversal pattern, which starts with a tall white bar carrying an uptrend to a new high. The market gaps higher. Again, in FX, this is not the case. This is mainly in equities, or in stocks especially. And then the buyers disappear with sellers not stepping up yet, resulting in a narrow range candlestick. And then the third is a very bearish bar, which completes the pattern, predicting a further decline, which will continue to lower lows, potentially triggering a broader scale downtrend. And based on Bulkovsky's encyclopedia here, this pattern has an accuracy rate of 72%, which is quite astounding, in fact. And this is what this refers to. So there's a strong uptrend, there's a strong bullish candle, then you have here this disappearance of buyers, but also sellers not yet stepping up. But then in the next candle, or after some period of time, some time elapsed, then they are stepping in, pushing the market significantly lower and showing that now the trend is potentially broken, and we should expect further declines to come in fact. And that's it around the evening star, in fact. So let's sum all this up. Yes, there are gaps between the candles if you look at it from an equity perspective, especially, and where the time is not 24/5 as we have in FX, but there is a closing time. For example, when looking at German stocks here, etc., Volkswagen or Daimler, whatever, you have the opening price when looking at etc. at 9 a.m. German time, and they close at 5:30 p.m. German time. And then there is a time span in between from 5:31 to 8:59 the next morning, where there's no trading taking place, but the world is still moving, and there is some developments overnight. And this, you can get a different opening price in relation to the closing price the day before, and thus such a gap is happening. That's not the case when looking at FX, obviously, but even though you can still adapt these patterns where you can use them, in fact, very strongly in FX due to the trend stability, which means if a trend breaks finally, it potentially breaks heavily, in fact. Time frame is not defined. In fact, you can use this on every time frame, even though we can say, and this is something I recommend, the higher the time frame, the more likely the sustainability of a move, in fact, based on such a pattern. Because more information and more volatility is included, in fact, in this candle. So I wouldn't use this on a 1 minute time frame, but I prefer to use it, especially when trading FX in general. In fact, I prefer trade H4, 4-hour charts, respectively, a daily chart, in fact. So, summary: candlestick patterns are technical trading tools which are originated in Japan, and candlestick charts pack data for multiple timeframes into single price bars and build patterns that predict price direction once completed. And the huge popularity has, in fact, lowered the reliability with hedge funds, for example, where algorithmic traders stepping in, how to say that, quantify the moves, respectively code them, and then try to extract value out of them, which diminish the overall advantage they've given candlestick traders at the beginning, once they were introduced here in the Western world. But there are still patterns which can be traded profitably thanks to their high rate of accuracy, like the ones we just introduced: the 3-line strike with 84%, 3 black crows with 78%, and the evening star with 72%. And that's it on the candlestick introduction, respectively, these three patterns, I'd recommend you to study in more depth to hopefully increase your overall profitability in your FX trading. On Monday, Paul will be here again, same time, and we'll talk to you about Elliott waves, how to trade using Elliott waves, and introduce to you to the question, answer the question: what are Elliott waves? Are they all correct up to be, or how to utilize them in your trading, and how can you trade using Elliott waves? Same time, Monday, 2 p.m. London, 27th of July. Check the inbox for the webinar link. For all of you right now listening to this in live, if you watch the video on YouTube, then head over to admiralmarkets.com. There's the tab Education, and there you have the webinars tab where you can register for all the Trading Spotlight webinars, not just with me and Paul, but also with Marcus, who will be here then on a Wednesday, or in general on Wednesdays. And there's the website, admiralmarkets.com. There are the contact details, and here is the risk disclaimer at the end. I wish you all the best. Happy trading. Watch your stops. Talk to you next week on Friday, the next Trading Spotlight webinar. See you soon. Have a great day. Have a nice weekend. Enjoy yourself. See you and bye-bye.